This podcast includes content created and/or enhanced using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast.
Have you ever stopped to think about how the managers running those huge investment funds actually get paid? Beyond just the salary, how do they really get a piece of the action when deals go well? Today, we're doing a deep dive into something that sounds technical, but it's actually shaking things up quite a bit in the financial world, especially for alternative investment funds right here in Luxembourg.
That's right. We're focusing on Luxembourg's draft bill number 8590. And it's not just some minor adjustment, It's a pretty major strategic overhaul of how carried interest is taxed. The goal is clear. Replace the old ambiguities with something permanent, transparent, and frankly, very competitive. It's about attracting and keeping the best people.
Exactly. So our mission today is to pull out the really key insights from the latest information on this bill. Think of it as your shortcut to understanding what matters without getting completely bogged down in legal jargon. And just to be clear, everything we discuss today is based on the information available as of August 4th, 2025.
And as we explore this, there are really three main things, three big takeaways we want you to keep in mind.
Okay, first takeaway. The creation of this powerful, permanent dual regime for carried interest. Basically, a choice. You can go for a very favorable low-flat tax if it's contractual carry, or potentially pay no tax at all under a capital gain setup if carry is linked to a personal investment. Quite something.
Second point, who actually gets to benefit? It's being opened up significantly. It's not just the direct employees of the fund manager anymore. It includes a much wider group of professionals involved in the fund. We'll get into the detail.
And third,
it's about embracing reality, market reality. The bill formally allows deal-by-deal carried interest payouts. This lines Luxembourg up with how things commonly work in global private equity and VC. It's a big practical change.
Okay, great overview. So let's unpack this properly. Starting at the beginning, where did this bill come from and where does it stand right now in the whole legislative process?
Well, it moved fast. Draft Bill 8590 was officially lodged with the Chambre des députés, that's Luxembourg's parliament, on July 24th, 2025. It came directly from the Minister of Finance, Gilles Roth, and it's designed to amend two key laws, the income tax law and the AIFM law. Right now, as of today, August 4th, it's been referred to the Commission des Finances, the Finance Committee, for review.
That speed sounds intentional. Why the push now?
Oh, definitely intentional. It comes straight out of the government's coalition agreement for 2023 to 2028. Enhancing the carried interest regime was a stated goal. So this isn't just reacting to something, it's a proactive strategic move. The idea is to fix those long-standing gray areas that were, let's be honest, a competitive disadvantage sometimes. They're aiming for a best-in-class, permanent fix, trying to get ahead of competitor countries.
Makes sense. So beyond just the tax side, what's the bigger ambition for Luxembourg here? What are they trying to achieve?
The main goals are, well, first, creating real legal certainty. That's huge.
Yeah.
Second, attracting and keeping those high-value front office jobs, the actual decision makers in Luxembourg. And third, really cementing Luxembourg's position as a top global hub for alternative investment funds, or AIFs. It tackles issues from older regimes, like the 2013 AIFM law rules, which were temporary anyway, and other parts of the tax code that just weren't quite fit for purpose anymore.
You mentioned front office functions and also substance. Why are those terms so important in today's global finance world?
Good question. It ties into big international tax trends like the BEPS, project base erosion, and profit shifting. Basically, tax authorities globally are looking much harder to make sure profits are taxed where the real economic activity happens, where the value is genuinely created. So by making Luxembourg super attractive for the key people, the fund managers, the senior advisors, the people actually making the investment decisions, this bill encourages them to physically move here. That strengthens the economic substance of funds based in Luxembourg. It makes the whole structure more robust if international tax authorities come knocking later on.
Right. That context is crucial. Now, this is where it gets really interesting for the managers themselves. You mentioned two distinct paths for carried interest. Can you walk us through those?
Absolutely. This dual choice system is really the core of the reform. So first up, we have what they're calling the contractual carry. This applies when the payout, the profit share, isn't tied to the person having to make a mandatory co-investment in the fund. It's defined as getting a share of the fund's outperformance, basically, profits above a certain agreed hurdle rate, which needs to reflect market practice.
And the tax treatment for that path.
It's designed to be very attractive. It's classified as extraordinary income, and it gets taxed at just 1/4 of the person's overall global tax rate. So in practice, that usually means an effective tax rate somewhere between, say, 11% and 13%, which is obviously much lower than normal income tax rates. And importantly, this is designed as a permanent regime.
Okay, 11 to 13% permanently. That's clear for the contractual route. What about the other option, the one linked to an actual investment?
That's the participation-linked carry. This is for situations where the carried interest is linked directly or indirectly to owning a stake in the fund, like when managers co-invest their own money. Under this option, the income received is treated as a speculative capital gain, and this is key. It opens up the possibility of a full tax exemption, zero tax.
Wow, zero tax. Are there conditions?
Yes, there are two main conditions for the exemption. First, the participation, the stake in the fund, has to be held for more than 6 months. And second, that participation can't represent more than 10% of the capital of the entity it's held in.
That's potentially very powerful.
Yeah.
And you mentioned something about the fund's legal structure. Does it matter if it's set up as, say, a company versus a partnership?
That's another really important clarification in the bill. No, the legal form of the AIF itself doesn't matter for this assessment. Whether it's a tax-opaque structure like an SA or a tax-transparent partnership like an SCSP, the income received by the individual beneficiary under this participation-linked route is always assessed as a capital gain. Of course, if you don't meet those two conditions, the 6-month holding period or the 10% capital limit, then the gain is taxed at the standard progressive income tax rates. But the potential for full exemption is there.
So it's definitely not one size fits all. How would a fund manager or sponsor actually choose between these two pillars? Can you give an example?
Sure. The flexibility is the main point here. Think about a venture capital fund. They might have lots of investments, maybe smaller individual carry amounts per deal. For them, the simplicity and certainty of that 11 to 13% tax rate under the contractual pillar might be the most efficient way to go. Less tracking hassle, maybe? But then take a large cap buyout fund, longer investment horizons, maybe bigger potential gains on fewer deals. They might well decide it's worth structuring things carefully to meet the conditions for the participation-linked pillar, aiming for that potential 0% tax rate. It really allows Luxembourg to cater effectively to the whole spectrum of alternative investment strategies you see.
That makes sense. Great flexibility. Now, moving beyond the two tax options, you mentioned the scope of who can benefit is also changing significantly.
Yes, this is another really fundamental part of the reform, a major expansion. Before, the rules were often interpreted quite narrowly, mainly covering direct employees of the Licensed Alternative Investment Fund Manager, the AIFM. Draft Bill 8590 basically tears down those limitations. It extends the benefits to any natural person, any individual who provides services, directly or indirectly, to the AIF itself or to its manager. This specifically includes people who are vital to how modern funds work, but might not be on the AIFM's direct payroll.
Like who, for instance? Can you give some concrete examples?
The official commentaries mention several examples. Think about employees of a separate company that just provides investment advice to the fund, or independent members of the fund's board. Also, partners in the management company or the distal partner entity, even external consultants or other key service providers who play a critical role. The key isn't their formal employment contract anymore. It's about their functional contribution to the fund's success and governance.
That really does sound like it reflects how these complex funds actually operate today. What's the real impact of widening the net like this?
Well, it supports much more robust governance structures, doesn't it? It recognizes that running a sophisticated AIF involves a whole team, an ecosystem of talent, not just direct employees. The old system could sometimes create an unfair tax disadvantage for bringing in crucial external expertise. By leveling the playing field, this new law lets fund sponsors build the absolute best team for the job, sourcing top talent for every role, advisory, board oversight, you name it. And they can incentivize all these key people with the same tax-efficient carried interest. This boosts the quality of management and governance, and crucially, it significantly deepens the demonstrable economic substance of the fund's operations here in Luxembourg. More real activity, more real people involved locally.
Okay, that link to substance is clear. Now, let's shift to something you flagged earlier as maybe one of the most commercially significant changes.
Right.
How the carry is actually paid out. Can you explain this deal-by-deal revolution?
Yes. Revolution might not be too strong a word here, commercially speaking. What the bill does is formally get rid of an old implied requirement. Previously, the understanding, or at least the cautious approach, was often that investors, the limited partners or LPs, had to get all their invested capital back across the entire fund before the general partner, the GP, could receive any carry. This bill explicitly gives the green light to the American-style waterfall. That means carry can be calculated and paid out as individual investments are sold profitably. You don't have to wait potentially 10 or 12 years until the very end of the fund's life, which was more typical of the traditional European-style waterfall.
Right. And why is that specific change, paying out carry earlier, so vital for attracting and keeping top investment talent, especially if a fund has that typical long 10 or 12-year lifespan?
It's absolutely critical for motivation and honestly for financial viability, especially for newer or emerging managers, and even for high-performing teams within established firms. Getting performance-based pay tied more closely to actual performance realizing gains on deals rather than waiting a decade or more makes the massive difference to cash flow and morale. By formally adopting the globally dominant practice, Luxembourg removes what was a pretty significant practical hurdle. It just makes the Grand Duchy a much more practical, attractive place to actually run a fund from day to day.
This bill clearly isn't just abstract theory then. It's going to require real changes in how funds are set up and documented. What are the practical steps involved? What needs to be done?
Oh, definitely. This requires serious work on the core fund documents. It's not just a quick update. The main one, the absolute key document, is the Limited Partnership Agreement, the LPA. That's the contract between the LPs and the GP. The waterfall clauses, how money flows back to investors, and the manager and the distribution clauses will need very careful drafting. They need to perfectly reflect whichever carry structure is chosen, contractual or participation linked, and make sure it aligns correctly with the new tax rules.
And beyond the LPA, what other documents need a careful look?
Several others. The offering memorandum, or PPM, needs to be crystal clear for potential investors about how the new carry structure works. Service agreements, employment contracts for the managers, advisors, maybe independent directors, they all need precise wording to lock in the intended tax treatment. And of course, the Articles of Association, the governing documents for the GP entity itself, and any special vehicles set up to hold the carry interests, they all need to be consistent. It really demands a joined-up approach, looking across all the documents with both legal and tax advisors. It's a significant piece of work, no doubt. Good news for specialist advisors, perhaps.
Yeah, possibly. Now, this all sounds like a big win for the general partners, the GPs. But what about the investors, the LPs? How might this shift the power dynamic in negotiations between GPs and LPs?
That's a very insightful question. Yes, GPs clearly benefit from lower tax on their carry, but sophisticated LPs, the big institutional investors, they won't just see this as a GP windfall. They'll likely view it as increasing the total pot of money generated by the overall economic pie that needs to be shared fairly. So I'd expect LPA negotiations to get even more focused, maybe less haggling over the headline 20% carry rate itself, and more deep discussion about the net economic alignment across the whole fund structure. LPs might say, okay, your tax risk on carry is much lower now, so maybe you can be more flexible elsewhere.
Interesting. How could that play out in specific negotiation points? What might LPs push for?
We could see pressure on a few fronts. LPs might push for a higher preferred return or hurdle rate, the minimum return they get before the GP starts earning carry, maybe 8.5% or even 9% instead of the standard 8%. They might also argue for lower management fees, especially if the carry is now potentially much more lucrative for the GP after tax. And definitely, with deal-by-deal waterfalls, clawback provisions will get intense scrutiny. If the GP gets paid carry on early winning deals, but later deals lose money, LPs will want very robust mechanisms, interim and final clawbacks, to ensure they get their capital back, plus the preferred return, before the GP keeps that carry. Especially now the GP's net take from the carry is higher.
Right. The details matter. Adapting to all this will obviously have costs. Can you give us a ballpark idea, particularly for the legal side of things?
Costs vary hugely, of course, depending on complexity. But just as a rough guide, setting up a relatively straightforward, lightly regulated fund might involve one-off incorporation costs starting around, say, 25,000 euros. Annual running costs could begin at maybe 20,000 euros. And yeah, a decent slice of that will be for legal and central admin support. What's also interesting is how legal pricing itself is evolving. We're seeing less reliance purely on the billable hour. More firms are offering alternate fee arrangements, things like fixed fees for specific work packages, capped fees, maybe blended hourly rates across different seniority levels. It reflects a move towards more predictable costs and value alignment.
That's helpful context. What about the timeline? When can we realistically expect this bill to become actual law?
Well, given it was lodged in July, and the clear government backing, the general expectation is for parliamentary approval sometime later in 2025. It still needs to go through the commission review, get formal opinions, the Conseil d'Etat opinion is mandatory, and then face the main plenary vote in Parliament. But assuming it passes smoothly, the plan is for the new regime to kick in starting from the 2026 tax year.
Okay, 2026. Now, let's zoom out a bit. How does this new Luxembourg approach really compare to its main European rivals? You mentioned the UK and Ireland earlier.
Right, the competitive landscape is key. If you look at the UK, they have a statutory regime, but it's known for being quite complex, and there's always this lingering risk of certain rules and the income-based carried interest rules kicking in and recharacterizing what looks like a capital gain into income. That could mean much higher tax, potentially up to 45% plus Social Security contributions. So complexity and some uncertainty there. Then Ireland. Well, Ireland doesn't really have a specific dedicated statutory regime for carried interest. That lack of specific rules creates significant ambiguity. There's a real risk carry could just be treated as regular employment income, potentially facing marginal tax rates up to 55%. Not ideal.
So compared to that complexity and ambiguity, what's Luxembourg's edge with this new bill?
It's the clarity and the competitiveness, really. Luxembourg is proposing the simple elective choice. You either opt for the contractual route, lock in a low tax rate around 11 to 13%, guaranteed by statute, or you structure for the participation-linked route and aim for that potential 0% rate, again, with the conditions clearly defined in law. Both options are set in stone by Parliament. That offers far superior certainty and predictability compared to the UK or Irish situations. For global managers, reducing that legal and tax uncertainty is often just as valuable, if not more so, than the rate itself. It's a clear, permanent, statutory safe harbor.
It really sounds like this bill is designed to be a cornerstone of Luxembourg's whole offering. What would you say is its truly unique selling proposition, its USP, now?
I think Draft Bill 8590 really elevates Luxembourg's USP. It creates this powerful combination, almost a synergy of four key elements. One, a world-class toolkit of fund structures like the RAIF and the SCSP, which are already hugely successful. Two, now a premier incentive mechanism with this best-in-class carried interest regime. Three, the existing, deep, sophisticated ecosystem of experienced, multilingual professionals, lawyers, accountants, administrators. And four, all underpinned by unrivaled market access through the EU passport, political stability, and that AAA credit rating. It's the whole package.
So it's not just about being a place to register the fund structure anymore. It's about attracting the people who actually run the fund.
Yeah. Precisely. That's the crucial point. This reform aims to complete the value chain. Luxembourg has long been a leader for fund domiciliation, administration, distribution, often seen as the back and middle office hub. The big prize, the challenge, was always attracting more of the high-value front office. The core investment teams, the senior partners making the decisions, the GPs themselves. Bill 8590 is arguably the strategic key to unlock that final, most valuable piece of the puzzle. It helps transform Luxembourg from mainly a place where funds are serviced into a premier global center where funds are actually conceived, managed day-to-day, and governed from. It cements that end-to-end domicile status.
Looking ahead then, what are the final hurdles in the legislative process? What should people be keeping an eye on?
Well, as I said, final approval is expected by year-end 2025. But the process isn't over. The review in the Commission des Finances, and especially the feedback from the Conseil d'Etat, could still lead to refinements or amendments to the text. So stakeholders should definitely keep monitoring the bill's progress through Parliament.
And even though the bill aims for clarity, are there any specific points or nuances that might need further clarification, maybe through official guidance later on?
Yes. Even with a well-drafted law, there are usually a couple of finer points. Two come to mind here. First, regarding the participation-linked exemption, there's maybe a slight ambiguity about how it applies to ongoing distributions during the holding period. Does simply holding the underlying share for over 6 months make all distributions exempt? Or is each distribution treated as a partial sale needing its own 6-month check? That might need clarification. Second, the term market practice hurdle rate for the contractual carry. What exactly constitutes acceptable market practice could vary across different types of funds: PE, VC, real estate, debt. We might see administrative circulars or guidance providing more concrete examples or safe harbors on what hurdle rates are considered acceptable.
Okay, useful points to watch. So, stepping back for the final assessment, what do you predict will be the real long-term impact of this reform on Luxembourg's financial center?
I think the long-term impact will be genuinely transformative. We should expect to see a significant new wave of AIFMs and GPs choosing to set up real, substantial operations in Luxembourg, not just letterbox entities. This influx of front office talent will deepen the local expertise pool even further, create high-value jobs, and spin off growth in related services. It creates a virtuous cycle. By offering this comprehensive end-to-end solution structures, incentives, talent pool, stability that is arguably superior in its certainty, flexibility, and competitiveness, this legislation is set to further cement Luxembourg's position. It reinforces its claim as the undisputed leader and the go-to domicile for alternative investment funds, not just in Europe, but globally.
Fantastic. So, just to quickly recap for everyone listening, the three absolute must-knows from Draft Bill 8590. 1. That powerful, permanent dual regime giving a choice between low-tax contractual carry and potentially tax-free participation-linked carry. 2. The much broader scope of beneficiaries welcoming the whole fund ecosystem and boosting substance. And 3, finally embracing market reality by formally allowing deal-by-deal waterfalls, making Luxembourg far more practical for PE and VC managers. It really feels like Draft Bill 8590 is more than just a piece of legislation. It's a clear statement of intent, wouldn't you say? It shows Luxembourg is serious about providing the most sophisticated, stable, and strategically attractive environment for the global investment fund industry. The effects of this will surely reshape the landscape for years ahead.
Absolutely. It's not just tweaking the rules, it's a strategic repositioning. It's designed to ensure Luxembourg stays right at the forefront of alternative asset management for the foreseeable future. A very significant move indeed.
Thank you so much for walking us through that. And thank you, our listener, for joining us on this deep dive. We hope you found it insightful and encourage you to keep following developments on this important topic.
This podcast includes content created and/or enhanced using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.